What is long-term care? The definition of long-term care is personal care or supervision needed by people for an extended period of time. It may be due to an accident or illness or the effects of aging. Some conditions that may require long-term care: Alzheimer's, Parkinson's disease, heart disease, head injury, stroke, just to name a few. And long-term care is custodial care, so it can range. Basically, when you get up in the morning, you got out of bed, so you transferred from laying down to standing up. If you needed assistance with that, that's actually considered one of the activities of daily living, which is a trigger for long-term care insurance. Basically, you've got 6: transferring from a bed or a chair, bathing, eating, continence. Those are just some of the triggers that long-term care policies use. If you need assistance with those things, then any 2 of those would actually mean that you would qualify for on a claim as far as long-term care and have the policy pay. These statistics to me were kind of eye-opening the first time I saw them. It's hard to believe, but 3% of the folks receiving long-term care today, 3% are actually children less than 18 years old. 40% are working adults 18 to 64, and 57% are over the age of 65. If you have assets to protect, again, talked several times about businesses and farms, because I do work with a lot of farm owners and a lot of business owners. Basically, if you have assets to protect and you are planning on passing assets and you don't want to see them spent, long-term care may be something you should definitely consider. And when I say long-term care, I'm not always speaking of insurance. Some folks can't qualify for insurance because of health. That's one reason. If you're considering long-term care, don't put it off. When I first started selling long-term care insurance has been around since probably 1988, 89. And a lot of people did not really start looking at it until you really started seeing a push for long-term care probably in the mid-90s. But then you had people 75, 80 years old wanting to purchase long-term care, and at that point it's very expensive. Or it can't be qualified for because they've had health issues that they can't qualify for. Something that's happened in recent years because of claims, insurance companies have tightened their underwriting considerably, so it's harder to qualify now than, say, it was back in the 90s. What I'm basically saying is if you're considering long-term care, whether you talk to me or whether you talk to someone else, you really should look at it sooner than later while you're in good health, because it's only going to get harder to get, and it does get more expensive. If you bought a policy today, say at 55 versus 75, it is a significant difference in those 2 premiums between the 2 folks. You're not financially eligible for Medicaid or close to qualifying is another reason to consider it, and you can afford the premiums if it's less than 7% of your income. And again, you're in reasonably good health. What are your financial advisors' credentials and experience? What companies do they represent? Is the carrier, basically the insurance company, highly rated? Do they have a history of rate stability? These are probably some of the most important, because if you're purchasing long-term care today, an insurance policy for long-term care, chances are it's not something you're going to actually use for possibly 20 or 25 years from now. And because of that, you want to make sure that the company is financially stable and that they have been in the business of long-term care for a long time. Back in the 80s, several companies jumped in the business and have since experienced so many claims that they've actually quit selling long-term care and actually sold their book of business. What that's done, though, for those folks that had the policies, they still have them, but they're having to pay more. This is a health insurance policy, so they could potentially increase premiums. Because of that potential, it's critical that you pick a good company and you pick a company that's stable. That's not to say that they too couldn't experience a rate increase, but you're less likely to have problems in the future. Reimbursement, indemnity, or cash, those are the three types of long-term care policies. Basically, a reimbursement policy is probably the most common and mostly what I'm seeing now as far as companies selling. Under a reimbursement policy, for instance, if you were to buy a policy that would pay up to $5,000 a month, you would, whether you were receiving home care or in a facility, whether it be assisted living or nursing home or hospice care facility, you would go into the facility and basically pay the first 90 days either through your own, out of your own funds or through other insurance. That's your what's called the elimination period or deductible. And then the reimbursement policy, you would basically submit your bills and be reimbursed for your actual expenses after that 90-day period. The nice thing about the policy too, it has automatic waiver of premium, meaning that once you're on claim and once you've gone that 90 days, you no longer pay premiums on that policy. If you're married and you have your two policies, the spouse's policies linked together, in some cases both premiums would be waived if one spouse was on claim. Indemnity and cash policies, those were sold for a while, a number of years back. I'm not seeing those near as much. They're tax advantages to the reimbursement policy, and I think with the cash and indemnity policies, that's one reason we have not seen that many of those recently. And I don't know that they're still available. Ability to afford during your lifetime, that's something important in figuring out what a client needs. When I sit down with the client and trying to help make sure that the policy is not only what they want, but it's also affordable, we also have to look at, you know, what's affordable going forward as well. How to make a long-term care policy affordable? Looking at the deductible, I mentioned it's called an elimination period. The most common elimination period is 90 days, and one reason most people choose the 90 days is if you have Medicare or you have private insurance. Under certain scenarios, if you had, for instance, let's say you had a stroke, or let's say I had a fall. I have a fall, puts me in the hospital, and I'm there for 3 days, and I'm 65, so I'm on Medicare. That actually would begin, the Medicare policy would actually pay for a long-term care under that scenario for up to 90 days. You may have a little bit of out-of-pocket cost, but you'd have coverage for it around 90 days. The long-term care policy, if it kicked in at 90 days, you would then have that coverage at that point. Another way to save money as far as long-term care, apply with a partner or spouse, apply while you're married, and while both spouses are alive and healthy. Considered a shared care rider. Shared care rider came out several years ago, and what it says, and it's a very good benefit, because, all right, I have a policy and my wife has a policy, and my policy basically would pay a lifetime benefit of $150,000. Hers would do the same thing. But the shared care rider, if you purchase that, what it does is it ties these two pots of money together. And that's really what we're doing. We're creating a pot of money to pay for your care whenever you need that as far as long-term care. The shared care rider, let's say I went on claim, and meaning that I needed home care. Let's say I needed home care and I qualified, and I had home care and even went into a nursing home afterwards. My policy paid out to the max of $150,000, but yet I'm still alive, and yet I still need care. Under normal circumstances, I would begin paying out of pocket. With shared care, I can actually access my wife's policy and continue drawing benefit. The good thing about that is it increases my likelihood and her likelihood that one of us is going to be able to use that, because in all likelihood, one of us is going to die and may not even use our pool of money. So it just increases your chances as far as having the money available to you when you need it.
What happens to the second spouse?
The second spouse, if this is exhausted, that's a good point. If it's exhausted, we would then have to start paying out of pocket. Got $300,000 pool of money between the two of you. Exactly right. The average stay in a nursing home is 2.5 years. Now that's in a nursing home. That doesn't take into account long-term home care. If you threw home care into that, I already tell you the statistics are not good for that, meaning we don't know. When I first started selling long-term care and working with clients with long-term care in the mid-90s, everybody wanted a lifetime benefit, which sounds great, but few people statistically across the whole industry, few clients have ever used a lifetime benefit, used it up. Now the rule of thumb is don't choose lifetime, choose somewhere between 2 and possibly 5 years and really look at what you can afford budget-wise. And shared care is a new rider, probably came out about 6 years ago. Back when people were choosing a lifetime benefit, they didn't have this option. So policies have kind of evolved quite a bit, and one of the newest things I'm seeing is a life insurance policy with a long-term care rider to provide benefit so that you've got some coverage for life insurance built in, long-term care built in. So that kind of is working toward how do you cover all these things that we're trying to cover at the same time. I mean, if you've got kids in college, you're planning for long-term care, you're planning for your own retirement, and you're trying to pass assets if and when you do die. Obviously, you're going to die at some point, but it's a lot to try to plan for. But those are just some of the things to consider. And again, that's considering a 3 to 5 year benefit instead of a lifetime. Compare companies with pricing. And another thing with pricing, you want to really look hard and press your advisor that's working with you to really show you some information as far as what that company has done in the past and what their rate history is, because statistics are out there now where a company's, luckily the federal government, a good thing about it, they've kind of made it so that policies have basically got to be, they've got to give you several options or background information, and also give you a rate history. If they've ever had a rate increase on an existing policy, they've got to tell you that. So you've got a lot more information. You obviously need an advisor to help guide you and help basically work down through all this information and try to figure out what kind of decision to make. What amount can you co-insure? Obviously, if you don't have long-term care insurance, you're footing 100% of the bill. Your best bet is probably to look at a combination of the two things. Figure out how much you can afford to pay if you needed care, and then how much it makes sense to actually cover by an insurance policy.